The stock market is currently closed on this Saturday evening, January 24th, 2026, so we are looking back at the official closing price for Northwest Biotherapeutics from yesterday, Friday, January 23rd. The stock ended the week trading at 0.299 after a session that saw it touch a high of 0.307 before settling just under that psychological 30-cent level. While the headline number shows a modest daily gain of about 2.5%, the real story isn't found in the decimal points of the Friday close. It is found in the unusually tight consolidation we have witnessed over the last 14 trading days, where the stock has essentially pinned itself between 28 and 30 cents, despite massive volume relative to its market cap. Investors often watch these flat lines with a sense of boredom, but in the case of this specific ticker, that lack of movement is actually the highest form of tension. It suggests a massive tug-of-war between retail conviction and a sophisticated shorting apparatus that is struggling to push the price into the teens, despite a lack of fresh news from the regulatory front. The common belief among the broader market and casual onlookers is that Northwest Biotherapeutics is just another over-the-counter biotech lottery ticket, waiting for a binary event that may never come. Many believe that the multi-year delay in receiving a definitive answer from the UK Medicines and Healthcare Products Regulatory Agency, or the FDA, is a sign of underlying weakness in the data. There is a narrative that if the Phase 3 trial results for 𝐷𝐶Vax-L were truly the breakthrough the company claims, approval would have been fast-tracked and finalized years ago. This skepticism is what keeps the stock in the sub-dollar range and fuels the bear case that the company is simply a perpetual capital-raising machine. However, a deeper look at the institutional positioning and the actual mechanics of the manufacturing scale-up suggests a very different reality. While the market waits for a piece of paper from a regulator, the company has been quietly aggressive on the infrastructure side. The recent move into construction for the Grade C manufacturing suite in Sawston is a data point that most retail traders are not pricing in correctly. Building out Grade C capacity isn't just a minor facility upgrade, it is a fundamental shift in the cost of goods sold. Most personalized cancer vaccines require Grade B cleanrooms, where only one patient product can be processed at a time. By moving to a closed system that allows for simultaneous production of multiple patient doses in a single suite, the company is effectively signaling that they expect high-volume demand. You do not spend millions on doubling or tripling manufacturing throughput if you believe a rejection is imminent. This disconnect between the stagnant share price and the accelerating physical infrastructure is where the contrarian opportunity lives. Institutional behavior recently has been a mix of quiet accumulation and tactical hedging. We are seeing small wealth management firms like Maloney Securities and Ethos Financial slowly ticking their share counts higher in recent filings, even as the overall institutional ownership remains low compared to the massive retail base. This lack of big bank involvement is often cited as a red flag, but in the world of microcap biotech, the institutions usually show up after the de-risking event, not before it. What is more interesting right now is the volume pattern. We have seen several days in January where the volume exceeded 3 million shares on days with almost zero net price movement. This usually indicates that large blocks are being swapped or that short positions are being covered and immediately reopened to maintain a lid on the price. Speaking of short positions, Northwest Biotherapeutics is currently one of the most debated names in the short interest circles. Current data shows roughly 57 million shares sold short, with a short interest ratio, or days to cover, sitting around 9 days. That is an exceptionally high number for a stock that has been trading in this range for this long. We are also seeing off-exchange short volume ratios frequently spiking above 60%. This means a majority of the selling pressure is happening in dark pools and away from the public eye, which often leads to the price suppression retail investors complain about on social media. Firms like Citadel and Susquehanna are often identified in these discussions due to their roles as market makers, and while they are not necessarily shorting in the traditional speculative sense, their delta hedging and liquidity provision can create a heavy ceiling on a stock with such a large float.
The short thesis is built on the idea that the company's use of external controls in their Phase 3 trial will never pass muster with the FDA. Short sellers argue that because the trial was not a traditional randomized controlled study from start to finish, the results are statistically tainted. They point to the various amendments made to the trial endpoints over the years as proof of a moving the goalpost strategy. On the other side, the long thesis relies on the peer-reviewed data published in JAMA Oncology, which showed a statistically significant extension of life for both newly diagnosed and recurrent glioblastoma patients. Retail investors can monitor these short dynamics by looking at the borrow rate, which has recently fluctuated between 6 and 8%. A sudden spike in this rate usually indicates that shares are becoming harder to find, which is often the precursor to a volatility event. Comment how many shares you currently hold, and let me know if you think the short thesis regarding the external controls is a legitimate hurdle or just a distraction used to justify the current price. The sentiment on platforms like X and Reddit remains fiercely loyal to the management team, led by Linda Powers. There is a strong sense of community coordination among retail holders who believe they are fighting against predatory market practices. While it is true that retail investors cannot directly move a stock with a 1.5 billion share float through coordination alone, their refusal to sell has created a floor that has proven very difficult for short sellers to break. This diamond hands mentality has effectively locked up a significant portion of the float, making the remaining liquid shares more sensitive to any sudden influx of institutional buying. When you look at what this company actually does, it is a pioneer in personalized medicine. Their lead product, 𝐃𝐈𝐒𝐂𝐋, is a vaccine made from a patient's own dendritic cells. They take a sample of the patient's tumor and their blood, train the dendritic cells to recognize the specific markers of that tumor, and then inject them back into the body. It is a highly complex, logistically heavy process that involves shipping live cells across borders and processing them in sterile environments. This is why the Sawston facility and the acquisition of Advent Bioservices were so critical. They are trying to solve the last-mile problem of biotech, which is making a bespoke, individualized treatment affordable at scale. Looking forward, there are three main scenarios to watch. The first and most bullish is a surprise approval from the UK MHRA. If that happens, the 150-day review pathway suggests we could see a move that forces a massive short squeeze as the 57 million short shares rush for the exit simultaneously. The second scenario is a continued delay or a request for more data, which would likely lead to a slow bleed as the company uses its newly authorized share increase to raise more capital, potentially diluting existing holders. The third scenario is a partnership with a major big pharma player. Many investors are speculating that a larger company with a global distribution network could step in to handle the commercialization of 𝐃𝐈𝐒𝐿 once the regulatory path is cleared. The expectation right now is that Northwest Biotherapeutics will remain a stagnant, controversial OTC stock until it either disappears or explodes. The reality is that the company is physically preparing for a commercial launch in a way that suggests they know something the market doesn't. They are building the factories, hiring the staff, and securing the intellectual property for a large-scale operation. Whether that preparation leads to a breakthrough or a bust depends entirely on the regulators, but the infrastructure is no longer that of a paper company. The core insight here is that the share price is currently reflecting the uncertainty of the past, while the balance sheet and facility construction are reflecting a planned future. The tension between those two worlds is what makes the current 30-cent range so critical. If the stock can break and hold above its 50-day moving average of 0.24 and its 200-day average of 0.24, both of which it is currently sitting above, it could signal a shift in momentum. We have moved from a period of if to a period of when for many of these infrastructure milestones. As we move into the second quarter of 2026, the timeline for the grade C-suite validation will become the next major catalyst to watch. Stay focused on the volume and the regulatory filings rather than the daily noise. Would you like me to do a deeper analysis on the specific short interest trends and fail to deliver data for the last quarter of 2025 to see if there is a pattern of naked shorting as often alleged by the retail community?